When you open up an economic calendar and you see this big red folder with the letters CPI next to it, what do? You call it a no trade day because it's too risky, only to come back to the markets later and find out you missed this massive move that maybe you could have taken a piece of, or maybe you do try trading it. Well, then you risk getting stuck in fake outs, consolidation, a crazy volatility depending on what happens with the data. Well, my name's Josh Purveyo. I'm the founder of Day Trading University, and I've been trading and analyzing CPI data for over 6 years. Everything I'm going to cover in this video comes from real world experience of actually doing it. There are a lot of different strategies or opinions on how to analyze and trade CPI. I'm not here to say what's right or wrong, but what I do want to do is share what I believe is the most common mistake that I see traders make when looking to analyze or trade CPI data. And then to show you why it's a mistake, I'm going to backtest the last 6 years of the markets. I'm going to break down 3 milestones for CPI. I'm going to show you the how and why CPI moved the markets and in what direction it moved the markets. We're going to do this for the US dollar. We're going to do this for gold. We're going to do this for NASDAQ. You can apply this to Dow Jones or SP 500 if you want to. They're all equities. The biggest mistake that I see traders make when trying to trade inflation data is that they believe that the markets will always react the same way when the data is released. Let me tell you a quick story on this. I was having a conversation with a trader and he was telling me how he trades CPI data, and this is the analysis or strategy that he said he uses. So he said he went back to NASDAQ and he backtested the last 3 years of data for CPI specifically. What he did was he went and found all of the days that CPI came out higher and tried to figure out what NAS did. What he found was, out of all of those times, 70% of the time when CPI came out higher, NASDAQ would drop. So his conclusion was, if CPI comes out higher and I take NAS sells, his conclusion was that he would have a 70% win rate. Now this sounds good in theory, right? Because trading is all about probabilities. So if I can find something that happens the majority of the time, it would make sense. But I'm here to tell you that there's a different way CPI works. Now, before I show you what I think is a better way to be looking at CPI data, especially if you want to profit from it consistently, we need to understand a few key terms. Starting with CPI, which stands for Consumer Price Index, also known as inflation. Fun fact, there is no actual piece of data that you get called inflation. We have a lot of different pieces of data that do measure the pricing changes, CPI being one of the most popular ones, but it's not actually called inflation. It's just CPI. Why does inflation matter to the markets? This brings us to number 2, interest rates. The Federal Reserve, which is a central bank, they use interest rates to control inflation. So just understand that interest rates are a tool to control inflation, and inflation is CPI. So remember the strategy that we talked about earlier. If CPI comes out higher and I take NAS sells, I'm going to have a 70% win rate. I'm not saying that. I'm paraphrasing this strategy. It should look more like this. If CPI comes out higher or if CPI comes out lower, how will this impact interest rates? In this scenario, you'd be like, okay, well, higher interest rates is bad for NAS, so I would take NAS sells. If it's going to make lower interest rates because inflation CPI came out lower, then you're going to be like, well, I'm taking NAS buys because lower interest rates is good for NAS. Now let's actually apply this strategy to the last 6 years in the markets and see how this works. We're going to start our journey in March 2020 when COVID happened. The entire world locked down. So what happens in that scenario is the Federal Reserve came in the exact same time and they cut interest rates to 0, which we can see right here in this little article. The reason they cut interest rates to 0 is because two things. They cut interest rates to 0 and they launched a massive $700 billion quantitative easing program. The reason this is important is because, number 1, with lower interest rates, inflation will typically tend to creep up. Money becomes easier to get. Loans become easier to get. Mortgages, businesses can spend money easier. So what happens is inflation starts to go up because there's a lot more spending. Also, they started printing $120 billion and pushing it into the economy. So how do we think that's going to impact CPI? Well, for March 20, we can see down here at the bottom, we were sitting at about 1.6% inflation. After they cut rates, after they did all this money printing, we ended up peaking at almost 9% inflation, which is the highest inflation has ever been in over 40 years. So we know inflation is going up. We know interest rates are at 0. How are the markets reacting in that time? This is gold. We have March 2020 here. So gold was going up. Now let's take a look at NASDAQ. NASDAQ was going up. We have March 2020 down here. We have, a little bit of choppy price action. COVID was a big deal, so you can kind of ignore the price action we had during the lockdowns. But once it started to clear up, the Feds cut rates, we started printing money. Now we can see a clear direction. And even if we take a look over at the US dollar, which is right here, we can see that there was also one direction. Down here it's March 2020. You guys should be able to see the date. And we had one direction going to the downside. So March 2020, we have inflation going up, right? We have interest rates dropping. We're at zero, basically. And this was the direction of the markets. The US dollar was going down, NASDAQ was going up, and gold up. So now we'll time travel a little bit, and we're going to go to March 2022. This was when the Federal Reserve first raised interest rates. It says here the Federal Reserve approves first interest rate hike in more than 3 years. And it says that they see 6 more rate hikes ahead, right? This is a big deal. And the reason that they were looking to do this was because of inflation. And if we take a look over at inflation, we can see that when they raised rates around 2022 in the beginning, and all the way to June 22, we still went from 5% to 9%. We almost doubled in inflation, even with the feds raising interest rates, right? So now, with interest rates going up, let's see how the markets reacted to this. So here's the US dollar. Once again, this was the drop that we had seen earlier, but look at the direction change. Look at the shift, and look how aggressive it is once March hits. There's November, December. Once we get into March right here, look at this massive push to the upside, right? So dollar shifted directions. Dollar was going down before, now it's going up. How about NASDAQ? If we take a look over at NASDAQ, same thing. We started consolidating, but once the new year came, January, February, March, right here, look at the direction change, right? And now it didn't last forever, but the direction definitely changed from what we see here. NASDAQ flipped to the downside. Gold is a little more tricky at this time. You can see right here in March when the Fed started raising rates, even gold started to change direction, right? It didn't last forever, nothing lasts forever. But remember, this is the daily time frame that I'm showing you. So this drop that I'm showing you on gold, it's substantial. You know, we're talking about 3,700 ticks, 3,700 pips, whatever you want to call it, $376 to the downside in a matter of 231 days, so a little less than a year. It's a pretty big move. Now, this is the environment that we're looking at for March 2022. We have inflation pushing up, we have interest rates going up, but the dollar's pushing up, NAS is going down, and gold is going down. If we compare that to March 2020, let's look at this. Inflation was going up, interest rates are going down. In March 2022, inflation was going up, and interest rates are going up. But look at the difference in US dollar, NASDAQ, and gold. Everything switched, but inflation didn't. Right? Does that make sense? Like inflation was coming out higher in both of these scenarios, but the markets completely flipped the direction. It has nothing to do with inflation. Well, okay, I don't want to say that. It's not that it has nothing to do with inflation. It just has more to do with interest rates. So if you can determine how inflation is going to impact interest rates, all you need to know is how interest rates impact the thing that you're trading, and you will know the direction of the thing that you're trading. Make sense? Whether it's gold, US dollar, NASDAQ, US 30, it doesn't matter. These are all really sensitive to interest rates. And this is how that works. Now, interest rates still take time to actually see their way into the economy, right? The feds don't raise rates and inflation immediately drops. If you take a look at this chart here, we can see a couple months after they started raising rates, inflation did finally start to drop, right? So it does work, there's just a time delay. Now, the Federal Reserve is going to start taking different action when inflation starts to drop. So let's time travel. I'm gonna show you one more example that will really, hopefully, drive this home for you. So we're gonna time travel a little bit to October 2023, where the Atlanta Fed President Bostic made these comments. And he basically just said the central bank need not raise borrowing costs any further. His actual quote is down here. He said, "I actually don't think we need to increase rates anymore." Pretty self-explanatory. He just came out in a meeting and said, hey, inflation is not that bad. We can probably stop raising rates. Okay, how do the markets react to these comments? What happened to gold, US dollar, NASDAQ? Let's go find out together. Now here's gold on October 2023. Look at the direction shift. Look how bullish we went, right? October 2023 is right here. Look how sideways we were, or even pressured to the downside when the feds were raising rates. And once they came out and they were like, nah, we're done, gold took off. Now, to be fair, there was something else that happened on gold here. It wasn't just interest rates that impacted gold. If you were to go, you can go back test all this. I just remember this off the top of my head because I was trading it. We have a gap right here. October 6, 2023 was when the Israel-Hamas war started. So it happened over the weekend. We ended up getting a gap when the markets opened. And this is what gave us these buys on gold, which shifted this direction. Now, in this environment right here, the market still thought the feds were going to keep raising rates. So now we have something bullish for gold, but something bearish for gold, right? It wasn't until the Fed speaker came out that really helped gold move, and then we get this massive push to the upside. And same thing, I mean, we go take a look at NAS. We'll go start at October 2023, right here. Look at the push, look at the direction. Now, obviously we get pullbacks, but I'm talking about the overall direction of the markets. That's what I want to know. I want to be able to have a bias. That way, when I see pullbacks, I know what direction to take the trades in because I know the directions of the overall markets. That's what's important to me. So after Bostic made these comments, October 2023, we had inflation pushing up, interest rates are now down, or they're gonna be going down, right? We're pausing, the next step is to go down, and this is what the markets did. US dollar dropping, NAS pushing up, gold pushing up. So let's compare that to all three events that we just looked at. March 2020, when the Feds cut rates and inflation was going up, interest rates were at zero. The US dollar was dropping, equities like NASDAQ and gold were pushing up, right? And then March 2022, inflation was still going up, and this is when they started raising interest rates and the market shifted direction. The US dollar started pushing up, NAS, equities started pushing down, gold, precious metals started pushing down, right? And then October 2023, it changes. Inflation now drops, well, it's been dropping. Interest rates, we've now shifted directions on interest rates, and the market's changed again. US dollar is now dropping, NAS is pushing up, and gold is pushing up. But if you look at all three of these scenarios, look at the top one and the bottom one. In these two instances, the markets are moving in the same direction, but inflation is moving in a completely different direction. Does that make sense? The point that I'm trying to drive home is that in March 2020, inflation data was going up, right? Take a look at this. March 2020, inflation's going up, dollars dropping. October 2023, inflation's going down, dollars dropping. This doesn't make any sense. It only makes sense when you take a look at interest rates because that is the underlying driver of the markets. It's not just CPI.